A word about stock structure. Many of these things are already commonly understood, but setting aside safes, which happen before shares are issued, there are two big classes of shares. There are common shares, which is what founders and employees get. And when you go public, everything becomes a common share, typically. There are investors who get preferred shares. What does a preference mean? It means you have a liquidity preference, that if there is an acquisition or you have to sell the assets, then the preferred investors are first in line to get cash back out. So that, if you take the extreme case, the investors put $20 million into the company to get half the shares, so they have 50% ownership, and the next day the company is liquidated, the investors get their $20 million back out, and then the other investors, the common share investors, gets what's left over afterwards, which in that case is zero. That seems to make sense, that if you give somebody a bunch of money to go do something and they decide, we're not going to go do that, or we can't go do that, and the investors decide, okay, we want our money back, that they can get their money back by liquidating the company. They can't ask for it back without, in a sense, dissolving the company under most circumstances. It also means that when there is a very rich liquidation, the preferred investors have a choice. Do you want to stand in line and get just the money out that you put in, or do you want to convert your shares to be just like the common shares, in which case you take all the money and you hand it out proportionally according to percentage ownership? And so what happens is that if there's not much money to go around, the preferred investors exercise their liquidity preference. They get their cash out. They don't participate in the upside. But if there's more money available, they do forego their liquidity preference and they get to share in the outcome, which is where high returns. If you're going to get a 2x, a 5x, a 10x return, it will come almost always because they gave up their liquidity preference and participated alongside of founders and employees. There are some other pieces of it. There may be warrants, which are various kinds of options typically requested by financial partners. The banks often do this as part of equity that maybe, depending on exactly what the nature of the deal is, they may be preferred, more often common shares. And there's an option pool that when you allocate shares, you don't want to have to go through the paperwork of creating new shares, authorizing new shares every time you have an employee join. So you create an option pool, which is then granted by the board to employees as they come on board from this pool. And it's important to have a significant pool so that you have that flexibility. And because investors generally don't want you coming back asking for new shares for employees very often, because that's dilution of their position. There are details associated with voting rights, and there are some kinds of votes that are done on an as converted basis. That means one share equals one vote, regardless of what kind of share it is. And there are some kinds of votes which are done as classes, meaning Series B votes, Series A votes, common votes, and you have to, for some change to be made, you need the approval of each class of shares in the company. And that's particularly important if you are changing the rights associated with a group of shareholders. You certainly don't want a situation where the majority of the shares are common shares and you vote as converted to screw over the preferred investors, or vice versa. That you can't have a situation where some class lost rights because some other classes of investors voted for it. Whoops. Okay, let's talk about how stock allocation and dilution work. And these are not the number you should have. I'm just using these percentages as indicators. So this is a simplified hypothetical example of a company with 4 founders at somewhat different levels of seniority and a few more employees before the seed financing. And then I show the effect of what happens at the seed funding, the A round, and the B round. I'm also assuming that we have some non-founder executives that are hired between the seed round and the Series A. Now, executives tend to be pretty expensive in terms of stock. They may be looking at something, depending on whether it's a CEO or a VP of marketing, rather different allocations, but they will be talking about wanting to see an eventual share of the company, which is in the rough neighborhood of 1% or so after all those rounds. So it may start out as, a meaningful 1-digit percentage of the company in the early round. So pre-seed, the founders have most of the shares, and you typically do create a pool for the early employees, even from the beginning. And then we said, here's a seed round, which is taking 20% free money, and we're expanding the pool. So we added another 9% to that pool. We've used some of that pool to hire, we're going to use some of that pool to hire executives, and the founders have been pushed down. And then B round, there was a significant share of the company, which is now owned by the Series A investors there. So and the seed investors got pushed down. The pool was pushed down because it was both because it's been diluted and it's been consumed and it's been topped up. So often as part of a funding round, you increase the pool. And the founders have been further crushed down. And then finally, we have a hypothetical Series B that got 35% of the pre-money. The A is crushed down, the seed is crushed down, the pool is crushed down, but it's been topped up with another 5%. So there's still the room to hire more employees. The executives, as expected, have their positions pushed down in absolute percentage, though if you were to dollarize it, valuation times percentage, it's probably gone up significantly. And the founders are now owning about 30% in this picture. I've kept this simple, not including any warrants, any stock options that go to advisory boards, or sometimes board members, especially independent board members, will have stock options. But it's a good rough picture of what happens round after round. When you're raising money.
Chris, I'm here, by the way.
Oh, good. Thank you, Barry. Great. And I'm going to try and finish up very quickly here. We've had lots of good questions along the way, so we're stretched out slightly. Fundraising, it takes time. You want to be networking always. You want to be finding ways of both polishing and sharing and establishing the themes that you're investing in. And you do walk this delicate line. How much do you say about what you're really doing with everybody versus how much do you talk about the general space that you're in and establishing your credibility and learning about those specific markets? But you're always selling. You're always learning. You're always trying to refine what is going to resonate. And then at some point, you get serious in figuring out which investors you want to talk to, figuring out what that investment pitch is, finding ways to get in front of the kind of investors you want. And then you are hopefully getting to a point where you're getting a strong interest. People say they want to do a term sheet. They give you a term sheet, which really defines in a nutshell, what kind of valuation, what kind of dollars they want to put in. And the lead investor plays a central role in building a syndicate, of figuring out who else they want in that. Because investors often like the idea that there are other people investing alongside of them. It shares the risk a little bit. There's a little bit of fear and greed trade-off here, depending on how hot the deal is. But it's good for you to have a diversity of investors because you get more perspectives. You have more people that you can draw on for relationships, and you have more options when it comes to subsequent rounds. It always takes longer than you expect. You want to keep it moving quickly because you don't want term sheets to expire or investors to lose interest or the next big thing to come along for that investor and they put their focus elsewhere. But it will take some time to do this. I get asked all the time about bootstrapping. Occasionally it makes sense to fund yourself because you have the cash. Your idea doesn't fit current venture biases. You're willing to take the risk of a long gestation period, or modest gains are okay. And sometimes in software, you don't have huge amounts of capital needs. You don't need to build out your own data center. You don't need 100 people. You don't need to build silicon prototypes. And so you can get to product market fit and a certain amount of market momentum, sometimes with quite modest capital, and you may be able to do it yourself and off the revenue that you generate. And you're hoping that you are able to generate some kind of viral process without a heavy sales effort or a heavy marketing effort. The obvious advantages are you have no dilution, you have no distraction from investors, you have total engineering and business control. Sometimes you can get good non-dilutive funding from government research efforts, and maybe you love living with your parents. It's harder to recruit because people will ask the question, well, are you really going to get to liquidity on this trajectory? How do I get paid? You may give me options, you may give me shares, but how are those going to be how am I going to get to liquidity? You can easily get trapped in low margin services because one of the ways you bootstrap is you say, well, I don't have the product ready yet, but I have got a really bright set of people and a mastery of a certain area of technology, and I'll do custom projects with companies that bring in the cash. Sometimes it's not very high margin, and you're, more importantly, strategically distracting people from building the great scalable product by working on some company's specific integration needs. And you don't have the support network that comes from professional investors. But there are quite a number of big success stories. Zoho, MailChimp, GitHub, Mojang Studios, Atlassian, all really bootstrapped, all different flavors of software, of course. But clearly, in the best case, it can be phenomenally lucrative in that it gives you both very high returns and very solid control.